What's the outlook for farm real estate amid a downturning farm economy and so many externalities affecting the economy and agriculture? That's what we're talking about in this awesome episode of the Business of Agriculture. Before we hop into this awesome topic, I want to tell you about my friends over at AgView Solutions. AgView Solutions specializes in helping farmers with transition planning, cost of production, strategic growth, biz opportunity analysis, and just overall improvements to your farm or agribusiness's bottom line, acting as an advisor. The team at AgView Solutions is comprised of consultants who also farm and run multiple businesses. They get it. Check out their service at agviewsolutions.com. They help farms in 25 states as well as Canada. They even do workshops that are tailored for ag businesses. You can find out more at agviewsolutions.com. That's agviewsolutions.com. Hey there, welcome to another fantastic episode of the Business of Agriculture. I got a great one for you today. Agricultural people love dirt. We love talking about, I'm not talking about agronomics, I'm talking about the asset, I'm talking about real estate, and I've got a great one for you today. He's a returning guest. His name is Howard Halderman. He is the CEO of Halderman Farm Real Estate and Farm Management. They're an Indiana-based company. They touch real estate, manage real estate, auction, sell real estate in probably roughly about 6 states. They actually host a webinar every quarter that I am the host of. It's called the Maximizing Your Farmland series. In fact, the next one's coming up March 25th. You might want to put it on your calendar. I've been doing that for a couple of years with them. I love it. It keeps my head sharp, and it helps it bringing in some new guests and some new topics. And I said, why don't you come over, Howard, and talk about the outlook for farm real estate values, what's going on. You have such a wealth of knowledge because of what you see every day, and this is something that a lot of people are probably asking. What's going to happen to all these real estate values? Man, farm economy is now in year 3 of a downturn. Doesn't look that good. Interest rates are still hanging around, 6-7%. Surely this real estate's going to go down in value. Mr. Halderman might have a different story for you. Mr. Halderman, thanks for being here.
Glad to be here, Damian. Appreciate the opportunity, as always. Farm real estate.
I guess start off with the hot stuff. This is busy season. Dear listener, we're recording this mid-February. You're going to hear it probably by early March. A lot of land is moving, and you're going to be surprised, as Howard was, it's not getting cheaper.
Yeah, we went into 2025, and I can look back in my notes. This is seminar season for me. So I get the opportunity 2 times a week, maybe 3 times a week, to be in front of audiences around our market, which is Ohio, Indiana, Michigan, and Western Illinois, or Eastern Illinois. And so we get around that market, and you're talking to folks, and fundamentally, corn and soybean prices aren't real rosy. Farm incomes are projected to have a negative sign in front of them.
Right.
And that's across the Corn Belt, the Mid-South, in a lot of regions, and for a lot of reasons. You would argue that land value should be in decline because of all those reasons you mentioned right off the top, Damian. And what was amazing to me in 25 is that we set an all-time record at Halderman on the measurement that we use for farmland sales. And so in our actual sales results, we analyze farms that are 90% cropland or more. We basically take their sale price and we divide it by the estimated productivity index of the soils. And that's called the WAPI, Weighted Average Productivity Index. And we use corn bushels because that's kind of the common denominator for folks in the Corn Belt. And you'll have a WAPI score that might be anywhere from 100 to 190 bushels per acre per year. And it's a rating of the blend of soils that exist on your farm. Or the farm that we're selling. We take the sale price. So let's say the sale price was $15,000 an acre. It has 150 bushels per acre WAPI score. That's $100 per bushel of productivity index value. If you go back to the middle teens, we traded at 50, and we traded at 50 for 6 years. And then inflation hit and Chinese demand hit, and bang, we jumped to 80 in the middle of 2021. And we've kind of traded 80. The high previous to last year was 2022, and we got to $86 per bushel of WAPI. Last year we were at 90. And you'd say, okay, I get 2022, all-time record in farm incomes. Mm-hmm. It should have been that high, right? Mm-hmm. And interest rates were going up then, but maybe not quite as high as they are now. So you look back at 22, and that makes sense fundamentally. Fundamentally, I'm not sure 25 being higher nominally makes a lot of sense until you think, well, farmland is an inflation hedge. We are still in an inflation environment. Farmland is very correlated to gold. Gold's at an all-time high. Farmland is an asset that has not been in an oversupply situation since the 1980s. I think if you look at Iowa, less than 1% of the farms sell. Indiana and Illinois, it's somewhere around 1.5% of the farms sell. It's very small numbers. And
by the way, but the person listening says the farm sell. What he means is on an annual basis. So just remember, we got all kinds of different listeners here, Howard, that, they're really sharp people in their field of agriculture, but they are like, what the hell is he talking about? Only 1% sell. We mean on an annual basis, which means what he's talking about is on any given day, if I wanted to go and buy farmland, it's going to be tighter in Iowa, is his point, because it tends to not move that much. It tends to be held for a longer term. Now, this may change as we move forward 10, 20 years ago, less of that reverence for the farm or the tradition or whatever. But the point Howard is making is in Indiana, on an annual basis, 1.5% of farmland transacts, right?
Correct. Absolutely correct, Damian. And that means it's very thinly traded, if you use a financial term.
Yep.
And I think because of that, not being an oversupply situation, that has been very supportive of land values. So for all those reasons, maybe it shouldn't be a surprise that we saw farmland finish 25, at least on our score, at $90 per bushel of productivity index value. So that was one surprise. And then you say, all right, well, we turn the calendar to 2026. What's happening this year?
Mm-hmm.
And sometimes when you turn the calendar to a new year, you turn to a new crop year, focus changes to the 26 crop. Honestly, fundamentally, things aren't real rosy. I saw yesterday in a presentation from The Ohio State University, they had predictions for crop net incomes for corn and soybeans. Soybeans somewhat profitable, nominally profitable. Corn was a little negative, a little bearish. And so when you look at those numbers, you start to say, well, there's no reason why farmland should be trading up. I look at our data, our sales data for the first month and a half at this point, and you'd say, well, okay, that's not a representative sample, but those farms that are 90% cropland or more are over $100 per bushel of productivity index. Now, it's trending down since January 1st. I think it's a small sample set of farm sales. But I remember saying this all last year, Damian, in March. Well, it's only been a couple months. Mm-hmm. In May, well, it's only been the part of the first half of the year. In August, well, maybe because of yields being a little whatever, we might see a downturn toward the fall. And it just never happened. So farmland continues to be a very valued asset.
So there's going to be a whole bunch of people that are on the production side of this that are listening to this show, and I got a smart audience, so they're the smart people. They understand the business aspect of it, but then they're going to say, I get the gripers, the coffee shop crowd, and we don't have them as listeners, thank God. But the coffee shop crowd, well, how's that going to keep going up in value? These people ain't even making any money. It's just a bunch of investors, or in our part of the world, investor from Chicago. So if you're listening to this, I've said it so many times. If I go to a Halderman auction and nobody knows who I am, I'm going to wear a name badge that says investor from Chicago, because every piece of farm ground that sells at a high number, when you go to the coffee shop, then the next day, I heard it was investors from Chicago that bought that. What is the justification for holding up so well? Because we know that we're in an economic downturn in ag. We know that 2025, almost 1/4 of farm income was due to subsidies, meaning 1/4, 23% of farm income last year was derived from the taxpayers of the United States of America. And that's not counting the crop insurance and other things that sort of backstop this industry. So there is that backstop, which keeps the value up. But if you look at the fundamentals, it's hard to make money producing the crop, which therefore should mean that the land base goes down in conjunction with farm income, but it hasn't yet.
Well, I think it is a little region specific. If you look at numbers from Iowa, Illinois, they show slight declines or very steady land values. They don't show any movement up like we did here in Indiana and Ohio.
Yep.
And there is a halo effect from economic development in the Eastern Corn Belt. We have more population. We have larger population centers. As a result, you also see things like data centers. You see things like large economic development projects. In Indiana, there's the LEAP project down at Lebanon. That was a 6,000 acre play that the state government put options on to buy and have bought some of it. Lilly's doing a big pharmaceutical development there. So those kind of transactions create 1031 exchange opportunities. Now, majority of the land in Indiana that's coming out of cropland and being transitioned to something else is going to residential. I want to be absolutely clear. It's not going to solar. It's not going to data centers. It's going to residential development. But even residential development, those people are paying a multiple of what farmland is worth. Mm-hmm. The sellers of that are going to then do 1031 exchanges. So it's not the investor from Chicago necessarily, but it certainly might be the old farmer from Indianapolis that sold for residential development that's doing a tax-deferred exchange. That it happens more often, and there's more volume of those kind of dollars in the Eastern Corn Belt. So I think that is very supportive of land values. I think also you talked about the government support payments. There were a lot of farmers that made good money in 21, 22, 23.
Yep.
Yes, 24, 25, not so much. Some at break even, maybe slightly above, others well below break even.
Yep.
But they generated a lot of cash. And so they've been burning through that cash from a working capital standpoint. But always be mindful, I'm always mindful of the debt to asset ratio in agriculture, and it's around 14%. So there's a lot of borrowing capabilities that sits on the sideline today that farmers can utilize when, and keep in mind, I think 60% of our transactions go to farmers down the road. That's who your buyer is most of the time. Where does he get that cash? Well, he's got the equity in some of the land that he owns, and that equity can be used to leverage new acquisitions. We talked right off the top, 1.5% of farms in Indiana sell on a given annual basis. Mm-hmm. So there's not a lot of transactional volume. Damian, I do know of a couple of counties this past year where we saw what I would call more than 1.5% sell. Mm-hmm. So a little more volume, and it was not financially driven.
I was going to say, is it because there was an area where they grow melons and the melons all lost money, so they all were losing their shirts, or is it because it just happened that way? Was it because of any crop or regional specificity? No.
No. In fact, one of the counties, Carroll County, Indiana, very strong historical ag county.
Yeah.
There was just more transactional volume. Most of the sales are what they call estate sales or generational transfer sales. One generation passes on, the next generation inherits, they want to sell the farm. That really is what driven it. Here in Wabash County, that was another county where we saw a lot of transactions in the second half of the year last year. And most of those were it was their time in life to sell. Yep. Or one was a retiring farm operation. Yep. So it was not a financial driven situation. It was just volume was excessive in those areas. And we saw land values not at high levels. They traded more in the $80 to $90 per corn bushel of productivity index as opposed to above that.
There's a thing. So if all of a sudden, you had a great big one, but let's just say in one particular county, let's say there's a bit more than 1.5% that's transacting just because of whatever, 3 big landowners sell for whatever reason. Do you see, because like you said, because 60% of your sales are the farmer down the road, meaning an actual operator and landowner.
Correct.
Because there's that, so that disputes the whole myth that it's the investor from Chicago. 60% of your sales are the farmer down the road buying, and then we'll get to the other 40%. But at some point, if there's so much that's there, you might see a little bit of a decline in values because the 2 farmers, 3 farmers, landowners within 6 miles have bought what they can or want to, and being financially comfortable, and then it gets a little cheaper. That's kind of what I just heard.
Yes, you see the 2 economic principles, basically principle substitution. So they're making a choice, right? This farm's closer to me. This farm's better productivity. I'm going to save my money. I'm not going to bid on this one because I'm saving my money for the one that's closer to me. So you've got that principle, and then you got opportunity cost. and really evaluating, well, okay, I'm interested in this one, but what's the opportunity there versus the opportunity on a future sale that I'm aware of that's upcoming? And so those two economic principles still rule the day, but it's choice. And when you have more volume and more choice, then you take a little bit of that peak value out of the marketplace.
Okay, I want to get into some of those other percentages, and then we'll talk about the impact of AI, the stock market, the inflation, all those sort of things, and then we're going to obviously we're going to wrap this up all with outlook of where we see things going. That's where this is going. If you're listening to this show, I want you to remember also you can check it out on YouTube. I've got tremendous growth over on YouTube. I had only 1,800 subscribers a year ago, and now I've got like 13,000. So please keep it up and hit subscribe. It doesn't cost you anything. Just go to YouTube, type in Damian Mason channel, hit subscribe. Doesn't cost you anything. I would also remind you that we get these on all the audio platforms, so please share this with somebody that can benefit from it wherever you get your podcast. And also you can check it out on Acres TV. We are growing that distribution channel also. All right, let's thank our sponsors. Tyler Grow is one of them. If you're looking for a cutting-edge bio-based solution that truly delivers a measurable yield performance with a great ROI, you need to know about Tyler Grow AgriScience. Tyler Grow did a field day at my place last year, De La Rosa Farms, Huntington, Indiana, and also a big trial. I put my first trial out, made me almost like a real farmer. People at Tyler Grow, by the way, the results were amazing. We got like 20 bushel bonus on beans with a couple of their products. So they have products that are upcycled seafood byproducts. That's right. It stinks. It's terrible. It smells like the silage juice that came out of the silo when I was a kid, mixed with dead fish. But it works. It's biological. It's stinky, but it is effective. It's powerful plant nutrition and crop protection chemistry, and it's made from seafood byproducts, not seaweed. This is real science powered by nature, built to positively impact your bottom line. The products from Tyler Grow do not require you to reinvent the wheel. They go right with your existing fertility and crop input program. No changes are necessary. It's about getting more for what you spend your money on by using these Tidal Grow additives. They're amazing. You want to learn more about this? Go to Tidal Grow Ag. Tidal like a big wave of water. Tidal. Tidal. Grow like what your kids do. TidalGrowAg.com. That's TidalGrowAg.com. Tell them Damian Mason sent you. On those percentages. That's not quite Paul Harvey, but it's damn close, Howard. I mean, it's right there. It's right there with my ability to go right in. Wells Lamont Gloves could be one of my sponsors, just like old Paul. Anyway, first off, the buyer, you said the 60% are the farmer down the road, and you said it on your transactions. There is that common thing, that belief, this fear. Go on Twitter or now X, and half of the ag people are typing in there that their lifestyle's being taken from them because somebody down, from some big city is buying their farm ground, and that's not your experience at all. Now, is that just in the Eastern Corn Belt where you operate, or do you think that that's pretty much the case? Because I read the stuff. I think 2/3 of buyers of farmland in Iowa are farmers down the road also. Am I right?
Oh, you're all correct. Yeah, all the land grant institutions do some sort of survey similar to that. And if you look at the surveys from Iowa State or Illinois, absolutely consistent that somewhere between 60 and 70% of the transactions are going to a farmer. So the other 30, 40%. In fact, I think Iowa's survey Iowa State did one in December, and they actually put in there 22% of the buyers were investors, and they said local investors. So they are more specific than investor. It was local investor. What does that mean? For us, that means Indianapolis, Fort Wayne, Lafayette, Chicago. Certainly, you get some folks from Chicago because they're doing 1031 exchanges out of that marketplace, and they find more value in Indiana than they do on Illinois farmland. But they're local in the sense they're from this part of the Midwest.
Yep.
They have a respect for farmland, and they want to keep their money in play in farmland, and they do it in an area where they can go and see it. Mm-hmm. And so I think there's value in that. And I've got a chart that shows that 85% of the absentee-owned land, those landowners live with it between 0 and 100 miles of the farm. So it dispels the myth that, it's this outside investor coming in. And then, by the way, 96.4% of the farmland in the United States is owned by U.S. entities. Okay. 96.4. So if you have a fear about foreign ownership, no, that's a very small percentage. And honestly, out of the 3.4, 1.2 of that, or a third of it, is Canadian owned. I used to say our friends from Canada. I'm not sure they like us so much anymore. Right. But 1.2 is Canadian owned. A lot of that's timber. which timber gets thrown into that 96%.
Yeah, I pointed that out a long time ago. Like, there's a vast tract in Maine, and everybody thinks of Maine as lobster and Portland, Maine. That's like one teeny little corner of that state. Maine is a very large state by East Coast standards, and the bulk of it is woods and moose, and a bunch of it has some Canadian ownership. And so, yeah, that's a great point to point. And also the thing about all the absentee owners. You know, there's folks that you and I both know in Wabash, Indiana, or Huntington, Indiana, that own some farm ground and live in town. And so are they absentee? Well, they live 4 miles from the farm. They live 7 miles from the farm. And so it might be that
technically they're absentee if they don't farm it themselves.
Yeah.
My farm is 15 feet from my house, and I'm an absentee landowner. Yeah. I see it every day, but I'm an absentee landowner technically.
Right. So the other part that you said that would bode well for this land is, on average, and this I think you meant across America, you said there's a 14% debt to asset ratio. Is that just in your marketplace? Is that Indiana, or is that the whole country?
That's the whole country.
Okay. So if you wonder why these land values are holding up, is that there's a 14% debt to asset ratio. Now, Adam Lash, and yes, I'm mentioning you, Adam. He's a very prickly little guy on Twitter. He'll say, well, that's because these old boomers, he's got a real problem with the generational stuff. These boomers are holding on to these assets that are propped up by government policy. That's why their debt that they have is just very little against the asset. And I say, well, when I hear these calls for we need to make it easier for young people to get into farming and buy land, we need to do some legislation. I said, well, does your proposed legislation wipe out half the balance sheet for Howard and me? Because we own farm ground and we didn't inherit this. You know, we're not 90. We're not in this for $200 an acre and now it's worth 12 or whatever. So I don't understand the push for it, but there's this idea that we need to do something to bring down the land values. Well, that's going to make that 14% debt to asset ratio 30, which doesn't still kill anybody, except for it just removes literally billions and billions of dollars off the asset of the balance sheet.
Well, keep in mind, last time we were at 30%, 1981. That was now, granted, you had interest rates at 3x what they are now, but debt to asset ratios of 30% are a challenge to service. Yeah. So I've got another slide that I've put in on my debt to asset, shows that the best quartile is 6% debt to asset. The medium quartile, the medium 50%, I should say, not quartile, but the medium 50% is at 18%. And then the high 25%, the top quartile, gets up to 34% debt to asset. So there are certainly operations that have a high debt to asset ratio for farmland. Granted, in other asset classes, in operating businesses, in manufacturing, you might have a debt to asset ratio that's much more leveraged than that.
Yeah.
But if you think that a farm generates a 2 to 3% cash return, how in the world are you going to service 6% debt, 6% interest on debt at a 50% or higher ratio?
Yeah.
The debt service capacity isn't there. So it stands to reason that we have to keep our debt to asset ratios below 20%. Just to make the economics work. I think the other factor is that there's 80%, I think 81% of the farms in Iowa have zero mortgage debt. I heard yesterday that in Ohio, 84% of the farms have zero mortgage debt. So that's a great underpinning of the economy. You asked the question, how do young farmers get in? And that's a valid question and concern. I think we're going through a consolidation phase in row crops that that has been going on for 250 years.
It's been going on. It's been going on for a strong 90 years. I point out all the time. We had the most farms we ever had in this country was 1935. There was 6.8 million farms. Today there's about 1.8 million. We've been consolidating very, very strongly. The biggest, I saw a neat chart. Neat if you're into ag economics. The biggest rate of consolidation, Howard, was post-World War II by about 5 years, like 1950 to 59. That 1950s, all this thing that there's a rose-colored lenses about the good old days and Grandpa's out there and his, Farm All M and all that. He was on the Farm All M taking over the neighbor's farm. So, the 50s was the biggest rate of consolidation we've ever seen in terms of a percentage rate. Yeah.
Yeah, they had the introduction of tractors.
Yeah.
You also had a lot of folks that fought in the war and went on the GI Bill to college,
Yep.
and all of a sudden took jobs in other industries.
Yeah.
So
And said, hey, honey, we got 3 kids now. You got your college diploma. You didn't get shot when you're in Germany. Thank God. You know what? Let's move to town and live in this nice little suburban house and not be out here like worrying about whether the pigs are going to die. It actually, for all the thing about people left the farm, some of them left the farm because it was easier.
very true, and that is one of the challenges. But I get the question because I present to Huntington University and Taylor University and Purdue University, various ag classes and business classes, and I get the question, Howard, how do I get in? And it's a valid question, but do you devalue the balance sheet across the board? Because you can't do it in a specific location.
Right.
You'd have to do it across all of America and take half the value out just so beginning farmers can get in. That's not the answer. And there's no market that would support doing that ever, because you're going to decimate rural communities if you did that.
So that was my point exactly. And so I have this group of younger people that are in their, say, 30s and early 40s in ag, which is interesting. They call themselves younger, calling for this. Like, we just need to devalue. I was like, well, how, all of a sudden, you think this is going to save these small towns? Trust me, Aunt Gladys is losing, $3 million off her balance sheet off the farm that, when her husband died and he doesn't farm anymore. I don't know how that helps you. So there's a big disconnect there that, and also it would take legislation to literally remove wealth. And I don't know that that's an answer anybody wants. The other part of it is,
economically, you'd say, well, that's not going to hurt anybody because it's, they're all owned by people that are older and they don't have any debt. Well, who it really hurts is those farmers that do have a lot of debt, that are the consolidators. They're picking up additional acres because Sam down the road is retiring. Mm-hmm. And so they're adding those additional acres. They're taking more debt for larger equipment mm-hmm. and bigger input price costs. And where do they get that leverage? Mm-hmm. Against the land that they own? Mm-hmm. If that land gets devalued, then all of a sudden they don't have the capability of picking that up. And it just will decimate farm economies across the Midwest or across the country in doing that. So,
well, and then there's the idea that that's going to prop up and help somebody that's 23. When you see this much blood in the street, this much devastation to the greater economy, then tell me how the 23-year-old, other than you can say, well, the 23-year-old's living in his truck and doesn't have any debt and doesn't have, any expectations, also didn't lose any assets. Okay, that's true. So I can tell you that when I was 23 and didn't have anything, I made a lot of money off of those that did. So it's usually better to have other people with money that you can make money off of versus them being washed also, because now you're...
Well, and therefore that comes to, I think you make the point of what's the answer here is, how do we create a marketplace for the young 23-year-old to engage with these farm operations that are getting larger? And as they get larger, Damian, I would argue it's a paradigm shift. They go from raising corn to growing a end product. So call it ethanol.
Yeah.
That is a manufacturing mind shift, I think, in farming. And as you get to 10,000 acres, let's say, as a grower, well, you can't do it all.
Right.
So you got specialists in the machinery. You got specialists in the crop input acquisitions. You got somebody else that's got landowner relationship responsibilities. Mm-hmm. And that is no different than a manufacturing plant. And that's where the young people can find their access into farming, is they can come in and fill one of those roles. They get the education coming out of Purdue or wherever, mm-hmm. and they can come in, interview for those roles, and maybe get started with a farm operation that way. It's still a family farm because it's owned by a farm family, but they're going to need outside labor and outside intelligence to manage it effectively. And I think that's how you get these younger folks involved in agriculture.
I've pointed out it wasn't necessarily easy 50 years ago to be young and get into the production of agriculture. And then the other part of it is, and this is an unpopular opinion, but if you're talking about producing commodities, which we do a lot of in this country, corn, soy, wheat, cotton, whatever, if you're producing a commodity, There's a lot of commodity production that young people hop into. I'm sitting here at my house in Arizona, and we grow copper. We grow copper here in Arizona. Oh, yeah, vast mines. Guess what? None of it's done by a 23-year-old just got out of college. It's done by a major corporation. So the only commodity production business model that is family-oriented is agriculture. Coal, copper, cobalt, name any other asphalt, shingles.
Right.
No 23-year-old is getting in the manufacturing of bottle caps. Alcoa's already got that handled. Hey, I want to get into a couple of things about the money that's now in this business and what we're going to do for Outlook. Because we promise we're going to talk about Outlook and where we see things going. And there's a lot of stuff affecting that. We got inflation. We've got this AI frenzy in the economy. We've got alternative assets. I want to get into all that. Before I do, I want to talk to you, my dear listeners, about nano yield. If you're looking for an edge this season, if you're a producer, you are an agricultural producer, I want you to think about nano yield. I'm wearing their hat. Nano Yield has products like Nano Pro that are patented mineral-based nanoparticles that go in the tank. That's right. You put them in your spray tank. If you go across the field 3 times your sprayer, you put this stuff in there all the time at like 4 ounces per gallon. It does not take a lot, but what you're trying to do here is get more effectiveness out of your crop inputs. If you want to improve your weed control, boost the fungicide performance, or get more out of your nutrients, Nano Yield technology is an easy, affordable way to protect your investment. Once you see this work, you will not spray without it. If you put insurance on your equipment, which you do, why would you not also insure your crop inputs? Nano Yield is family owned and proudly makes all of their products right here in the United States of America. You can learn more at Nano Yield's website, nano-yield, just like my website says right here, nano-yield. Check out their grower testimonials on YouTube. That's nanoyield.com with a hyphen in between nano and yield. The things that are impacting this, okay. You and I have talked about it on your webinar, and again, I'll remind you, if you're watching this show or listening to me, check out the Halderman webinars. You can go to their website, and I have it pulled up here just to help you out. It's Halderman.com, Halderman, H-A-L-D-E-R, Halderman.com. Maximize Your Farmland Series webinar, and the next one coming up is on March 25th. It's free to sign up. I'm the host. Howard kicks off with a big market update, and then we always have a guest. We'll be talking about highest and best use and whether or not you're attaining highest and best use. That's what we're covering. So anyway, one of the things we cover is the inflationary impact. Inflation, big news, man. The government's touting that we're down to 2.4%, which is still not that low. we spent decades in the sub 2% range, which is really, really good for the American consumer. Right now, we've got inflation being tamed. When inflation gets tamed, does the luster for farm ground, hard assets like gold, does it go away?
Farmland is a long-term asset, Damian. And, we've talked a lot on this podcast about large institutional investors not being a major buyer in the marketplace, but they are a buyer. They're not a significant buyer, but they do buy farmland. And I get the opportunity at a couple of times a year to engage with these large institutional endowments, pension plans. That's what we're talking about. Mm-hmm. And they have allocations that they make of their $1 billion of funds. And it might be 1% to timber, and it might be 1% to agriculture, and 2% to infrastructure. So they're making this allocation to agriculture. And when you're talking to them for, 2010 to 2020, I would talk to them about farmland is an inflation hedge. You ought to be in farmland because if we get into an inflationary environment, it has a 1-to-1 correlation. That was never a big issue because we had no inflation.
Yeah.
Very little. And all of a sudden 21 hits. Mm-hmm. Farmland goes up 40%. Why? Part of the reason was we were in a very inflationary environment. Now, what I hear from these folks, Damian, is we want to invest in farmland, not because the current fundamentals are all that rosy. We want to be in farmland because we now respect it as an inflation hedge. Oh, by the way, gold is viewed as an inflation hedge. It's an inflation-sensitive asset. So gold's has been recently at an all-time high. Yep. Farmland is at an all-time high. Maybe that's not a surprise. I think there's still a lot of folks out there that look at those kind of assets and say, part of our portfolio ought to be invested in an inflation-sensitive asset, and farmland is that. So I think it's still an influence. Certainly when you get down to 2.4%, that's a little less of an influence. But is there a long-term belief that inflation is going to stay there? And I'm not sure the market is convinced that, oh yeah, we're 2.4% for the next 10 years. I think if that's the case, then the inflation argument for farmland kind of goes by the wayside again. But I doubt people are really convinced that we can stay there just yet.
So yeah, I'd say there's still an inflationary pressure out there compared to the several decades of almost no inflation. And then you wonder, let's say they get tamed and they actually reverse it. You and I have not seen deflationary. We've seen recession. We've seen rapid declines in values of assets, farm ground, housing, whatever. But that's different than those were like sort of shocks, if you will, from 9/11, COVID, whatever you want to call it. Do you see anything what do you see that would bring farmland down? We talked about legislation to help out young people, and that's not going to happen because the politics of it and also because the sheer devastation. And again, we're not being offensive to younger people that want to get into this business. It's just that these are the fundamentals that aren't probably likely to change. You and I don't think so. Policy, I think there'll still be policy that fosters along young people in agriculture, but I don't think you're going to see policy that then let's figure out a way to knock 50% off the value of farmland out here in Iowa because, my God, all of a sudden, well, first off, the banks alone, and then any local restaurant, and all of a sudden you have every little town that just dries up worse than they already have. So, what do you see that brings down land values?
Well, I think what would drive demand land values down is going to be an oversupply situation.
Yeah.
So, what creates more supply? And what happened in the 1980s was really driven off oversupply due to foreclosures. Mm-hmm. Can we go back to that? I think it's hard when 80% of the land out there has no mortgage debt on it. Mm-hmm. Now, could you get an uptick in supply, say to 3% instead of 1.5% selling in a given year?
Yeah,
sure, that could happen, but that's probably going to be a financially driven situation, and that could create some downdraft in farmland values. If you go back to 2014 and 15, that was an extended period of lower commodity prices, lower farm incomes. Mm-hmm. And I would argue that we went through 2014 through 2019 at break-even levels in farmland for a long period of time. Land values did not move that whole time frame. They dropped 10 to 15% from 2013's highs. So that's really what could happen, I think, is you could see a drop of 10 to 15%, but it has to be in conjunction with the general economy weakening as well. And so if you don't have residential expansion, if you don't have data center money, if you don't have some tax-deferred exchange funds coming into agriculture looking for land, combined with low farm incomes, and the farmer is looking at it and saying, yeah, I just can't afford to pay $15,000 anymore. I might be able to pay 12. Well, that's that 10 to 15% decline that you could see. That'd be 20 in my example. That is, to me, a realistic scenario. I don't see the 1980s repeating it because we just don't have the debt structure out there. That was a 60% decline over a 5-6 year period. In this case, we had a 15% decline in a 2-year time period. Could that happen again? Yes. But that's going to be longer extended negative farm incomes combined with a general economy that's slowing down.
15% decline in the next couple of years is very probable. A professor from U of I, University of Illinois, predicted a 20%, I thought, by the end of this year. Am I not right about that? Didn't we see that?
That I don't know. Okay. I haven't seen that. I did see the Iowa State survey from December.
Okay.
They had a majority of their folks were stable to down 5 to 10% in 2026. But over a 5-year time period, by 2030, the majority were in a 10 to 20% increase. So looking at a near-term decline followed by long-term appreciation, which if you go back the last 25 years in farmland using USDA farmland values,
yep,
the average appreciation in Indiana is 5.3% for 25 years. Mm-hmm. We had 40% in 21.
Yeah.
We had some declines in 09. You had some declines in 14 and 15. But on that 25-year average, it's 5.3%. Mm-hmm. In Ohio, it's 5.8. Ohio doesn't have better land. Ohio just has bigger halo effect from larger communities and a bigger population.
Right.
So I think you could see that 10 to 15% downturn for a year or two, and then it would probably be back to the incline, assuming that we get some improved farm economics.
So one of my questions I had was, who gets hurt and who gets hurt the most and the least. And as you said, one thing that you and I have talked about in Indiana, where you and I operate, we have precipitation and population, and those two things tend to prop up value. And it's not because we love the idea that farm ground gets sold for a residential development, but there's 6.8 million people in Indiana, whereas there's only 3 million people in Iowa, and Iowa's 60% larger than Indiana. It tends to be that land has more demand. But on the thing of getting hurt the most and the least, you just gave a pretty plausible scenario that we're going to hang around up here. Interest rates go down, which they're supposed to. That should actually be price positive for real estate. So you've got inflation going down, but so do mortgage rates and interest rates. They kind of wash, yes?
Yes, and so we're down. I think the Federal Reserve Bank of Chicago showed we were down 92 basis points from the high in October of 24.
Yep.
So interest rates have come down. In fact, with the lender yesterday, and their rates came down a tenth across the board yesterday or over the weekend because the market came down. So we are seeing that. That's a positive feature. So I think, we would call land values stable with a potential to see some increase this year. We have record corn exports. Could you see year-round E15? I think that Congress, I was with 2 U.S. representatives last week at a meeting in D.C., and they both said, yes, that will get done.
You think that they're saying we will see around E15, which is price positive for the Corn Belt. Okay, last thought, surpluses and low prices. Are we going to see land cycle out of agricultural production? You and I are old enough to remember when we did, and you and I also are old enough to remember the CRP, which came in 40 years ago and took 23 to 27 million, I think is the acres right now, out of production and put it into a government contract. CRP actually is price positive also. Young guys don't like that also. They say, you're taking away ground that I could have bought. And I shot a video about this, Howard, once, and I said, was giving the crappy ground that's highly erodible that should be put into prairie grass to young guys, is that really helping them out? It seems like, hey, kid, here's this turd. We just helped you out.
No, I could there be a reduction of acres in the United States? There will continue to be. I think our Indiana State Department of Agriculture Director, Don Lamb, commented that over the last, 10 years, we've seen 350,000 acres go out of production in Indiana. And I said, Don, what's that most attributable to? He said, well, number one, it's residential. Yep. Number two is manufacturing and warehouse space. It's not solar. It's not those other uses. One might make the argument today with commodity prices where they are, we're in an oversupply situation. So we're not at risk of food issues here in the United States by any stretch. There will continue to be some land get developed, whether it's for data centers, whether it's for residential, whether it's for industrial expansion. That will continue. I don't know that's going to pick up in pace necessarily. That'll really be general economy dependent. I also don't see a lot of federal programs coming out where they're going to encourage taking land out of production, like the CRP program. I think that continues. I don't think that changes anyway, but I don't see a big increase in acres up to 40 million acres like it used to be.
See, no, you and I disagree on that one. I see it coming in way of it'll appease the environmental approach and waterways and nutrient management all in one swoop. So I think it'll be somewhere between an EQIP and a CRP type of a thing. That's just my prediction. So I do see it expanding. But again, based on the surpluses and the productivity, if we grab another 10 million, an additional 10 million acres and take it out, I don't think it moves the needle a lot in way of supply.
No. So I think
it'd be the worst acres, right? It'd be the
right. Always, it's going to be the ones that flood 2 out of every 5 years.
Yeah.
I think if you think about commodity production, certainly Brazil and Argentina probably beat the U.S. in that. They're lower cost of production.
Yep.
They got lower land costs, lower labor, et cetera, et cetera. So as a U.S. producer, what's my future? A lot of it's domestic demand.
Yep.
And fuels is an option.
Yep.
And this renewable diesel, could consume a lot of our soybeans and corn via ethanol. The thing we're really wrestling with is what's the 45Z requirement going to say?
Yep.
Is it all no-till, all cover crops, or is there some relaxing of that? And does that open the door for ethanol to go into renewable diesel? If it did, combined with E15, I think you could see corn prices back to very profitable levels. I think you could see soybean prices. We're close on soybeans now at being at a profitable level. So to say that we're really decimated in corn and soybeans, we're not. And I think there are a couple of things that could happen to put us in a positive position there. Cotton, not so much. That's got a bigger challenge. And I think rice has also faced a lot of challenges. Those crops are heavily dependent on exports, and they've been hurt a lot.
Yep.
So I, as your growers around the country are listening, I don't want to just broad brush this and say corn and soybeans have a fix in.
Sure.
Those other commodities are really struggling.
Yeah. So the big outlook here, what I heard is it would be absolutely, you see 10 to 15% of downside on the values easily in the next few years, but not anything devastating. The likelihood of an 80s, which I agree with you, and I think there's a lot of policy. And again, no offense to the people saying, we need to make it easier on these young people. You wipe out 60% of asset value, like we saw in the 1980s. These younger people that are saying that'd be good for young folks. I'm like, and bankers got shot, and it's literally, and you and I both remember, bankers got shot, and families went through like the worst crises you can ever imagine. I don't know that you want to wish for any of that. So 10 to 15% decline, probably plausible. But you say if you're saying if I'm looking ahead to 5 to 10 years, I still think it's a good place to be.
Oh, Farmland's had that history Halderman's been in business 96 years. You go back to 1930 when we started to values today, and over the long run, you're going to find that farmland appreciates at 4 to 5% a year. That's just what it does. Yes, there are downturns. Every market has downturns in a capitalistic society. But 4 to 5% is kind of what you can count on when you start to talk about long-term predictions in farmland values.
His name is Howard Halderman. He's the CEO of Halderman Real Estate and Farm Management. They are a Wabash, Indiana-based company. They predominantly serve, I said 6 states. He said 4, but he's also got your fingers on a bunch of other different things going on. Also, you're involved with a company called U.S. Agriculture, which is a different story. Can they find information about that over if they go to Halderman, or they would just where do they find that?
usagriculture.com, us-agriculture.com. U.S. Agriculture is an asset management business where we build farmland portfolios for folks. And we got about $700 million in assets under management there.
And then Halderman Real Estate and Farm Management does auction management, listings, sales, etc. And they can be found at halderman.com. So you've got both those, right. us-agriculture.com, halderman.com. And also check out when you go there, you can sign up for our next webinar. I host it. I've been doing this for a couple of years with these guys, 2.5 years, I think it's been now. Every quarter. The next one's March 25th. You can sign up for that. So check it out. Thanks for being here, Mr. Halderman. I love the information.
Thanks always. And if they sign up, Damian, they don't have to be there that day live with us. It's better live, we would argue, but
because they can be interactive. If
it isn't convenient for them, they can always listen later. So that's the advantage to signing up. We have your email. We'll send the podcast to you later.
Got it. So till next time, he's Howard. I'm Damian. Thank you very much for being here. This is the Business of Agriculture. Thank you for tuning in to this episode of the Business of Agriculture, brought to you by my friends at AgView Solutions. I told you up front about AgView Solutions. They're an advisory group for agriculture professionals that can help you in your agricultural business and your farming operation. Maybe it's transition planning, analyzing your cost of production, strategic growth initiatives, discovering business opportunities and ferreting them out, overall improvements to your farm and your agricultural business. That's what they do as advisors. The team at AgView Solutions is comprised of consultants who also farm and run multiple businesses. They get it. You can check out their services at agviewsolutions.com. They help farming operations in 25 states as well as Canada. agviewsolutions.com. Check it out.